Welcome to Financial Insights in Minutes, where we bring you the latest in real estate trends.
In today's episode, we're highlighting urgent warnings from industry leaders about the housing market.
Recent discussions from key experts signal downtrends from rising interest rates and consumer challenges.
We'll also unpack insights on refinancing and the future of index funds for beginner investors.
Buckle up as we summarize the most important takeaways from several videos today. First, Airbnb CEO issues a stark warning about travel downturns. Next, Zillow reveals that 80% of sellers are forced to sell. Jim Black shares powerful tips to avoid success pitfalls. Experts analyze the looming housing market crash. Gain insights on passive investing through index funds. Discover refinancing strategies for conventional loans in 2024. Subway warns of dire consumer conditions impacting the economy. Finally, we expose the housing market collapse and rate cuts. Welcome to Reventure Consulting. Today's topic, Airbnb is ringing alarm bells about a major economic downturn.
That's right, they've missed their earnings, and there's a forecasted slowdown in U.S. travel. Buckle up, folks, it's diving deep into the economy.
So what's the bottom line on Airbnb's latest earnings report?
The core thesis is that the downturn in U.S. travel, evidenced by their earnings miss, suggests tougher times ahead, not just for Airbnb, but the entire economy.
Let's break down those key points, starting with Airbnb's stock performance.
Their stock took a nosedive of 14% following the earnings miss, now down about 25% since their IPO. Ouch!
And what's happening with demand?
Demand for travel is slowing down, with shorter booking times and less revenue growth. It's a trend we're seeing across the board.
How is this affecting the housing market?
As Airbnb operators face declining revenues, they're likely selling off properties, boosting housing inventory, especially noticeable in Florida.
And what about quality control on Airbnb?
Many guests have encountered poor customer service and inconsistent host experiences. It's a risk that could deter potential bookers.
What about their revenue model?
Airbnb's average rental rate is higher than hotels, plus they obscure financial performance by mixing rentals with experience bookings. Mysterious, right?
What predictions can we draw from this?
With more signs of economic downturn, Airbnb's popularity may continue to wane, especially if prices remain high and service is low.
Any thoughts on real estate dynamics?
As distressed Airbnb operators sell properties, expect housing inventory to increase, possibly leading to losses for those sellers.
What are the key takeaways?
The need for quality assurance in both travel and housing markets is crystal clear, especially as Airbnb faces such significant challenges.
Any final thoughts on Airbnb's strategy?
For Airbnb to regain consumer trust, they must enhance customer service and ensure host quality control. Otherwise, they might sink into deeper waters.
As we wrap up, we want to know your thoughts. How do you see Airbnb's future unfolding?
Comment below to share your perspective. Let's stir the conversation.
Welcome back to Real Estate Mindset. Today's topic is hot off the press. Zillow's July housing market report reveals shocking data that might change everything for homebuyers. Get ready for some mind-bending insights.
And those insights aren't just random musings. They're based on some serious data crunching. Zillow's finding that 80% of sellers are forced to sell is something you don't hear every day. Time to buckle up, folks.
So, what's the big picture? What's the thesis here?
The core thesis suggests that the housing market is in distress, with most people selling out of necessity rather than choice. This signals a turbulent market that could lead to drastic changes in home prices.
Let's dive into the first key point. What's driving these forced sales?
As revealed, a staggering 80% of sellers are doing so because of major life changes, like job loss or family growth. Couple this with homes being just $200 more than rents, and you see the pressure mounting.
Interesting shift in the market. What's the scoop on its neutrality?
The market is now neutral, meaning buyers and sellers are on equal footing for the first time since 2019. Homes are taking longer to sell, signaling weak demand.
What about inventory? Is there more stock available?
Absolutely. Inventory has risen by 25% compared to last year, and a whopping 26% of homes had to lower their prices in July. The supply is there, folks.
Let's peek into the crystal ball. What does the future hold?
If sellers regain the ability to sell, we might see an influx of homes on the market, which could drive prices down significantly, bursting the housing bubble.
Any surprises in specific markets to watch?
Yes, Austin is nosediving while places do show stability. Each market reacts differently. It's essential to keep an eye on local trends.
So summing it all up, what lessons can we take away?
The overwhelming data points to chaos in the housing market. Potential homebuyers should think twice before diving in, while sellers should consider their options carefully. This is a stormy sea out there.
And before we close, we want to hear from you. What are your thoughts on these trends? Do you think the market will rebound?
Definitely drop your thoughts in the comments. Engaging in the dialogue is how we navigate through these turbulent waters together.
Ahoy there! Welcome back to Ken McElroy's channel. Today, we're diving into something many need to hear: the 3 habits that are sinking your chances of success. Buckle up, folks.
Absolutely. These 3 pitfalls are where most people struggle. Ken McElroy, with his wealth of experience and knowledge, breaks down how to steer clear of them. Let's get straight to the facts.
So what's the crux of Ken's message? Why do so many people miss the success boat?
Ken argues that the main reason is due to 3 key habits that undermine success: selfishness, irregular efforts, and a negative attitude. Let's explore these habits further.
All right, let's take a closer look at self-centeredness. What did Ken say?
Successful individuals always look to contribute, whereas unsuccessful folks are in it for themselves. It's all about shifting your focus to service.
Now, what's this about consistency?
Ken emphasizes that the key to success is in daily routines. While successful people have structured systems, unsuccessful people rarely stick to a plan.
And what about attitude?
A poor attitude can lead to isolation. Successful individuals cultivate positivity, while those with bad attitudes tend to complain and blame others.
So what are Ken's predictions regarding change?
He believes that recognizing and altering these toxic traits is crucial. If you want success, you must be willing to do some soul searching.
And what does this mean for the future?
Ken argues that those who cultivate good habits and mindsets will thrive, while the rest may find themselves left behind.
So, what's the big takeaway here?
Success isn't just a dream, it's attainable. All you need is to shift those habits, build consistency, and foster a positive mindset. Time to navigate towards success.
What about personal accountability?
Absolutely. Take a moment to evaluate your habits. What are you ready to change to conquer the seas of success?
As we wrap up, viewers, we want to hear from you. What changes are you considering to set sail towards success?
Let us know in the comments. Your input could inspire someone else on their journey.
Welcome to Bigger Pockets. Today, we're diving into the turbulent waters of the housing market. With recession fears looming, questions arise. Is a housing market crash imminent?
Absolutely. It's a heated topic. Today, we're joined by real estate veterans James Dard and Jay Scott, who have been through market ups and downs, notably during the 2008 crash. Their insights are invaluable.
So, what's the core thesis of today's discussion?
The main thesis is a deep dive into whether the housing market is on the verge of a crash, analyzing economic indicators, investor sentiment, and what history tells us about potential declines.
Let's break down the key points. First up, despite economic fears, how is the housing market standing firm?
Historically, real estate often remains resilient during recessions. There's a pattern. 34 out of the last 35 recessions had minimal impacts on housing values.
And what about inventory levels? Are they trending up?
Yes, the data indicates an increase in inventory, substantially higher than last year, hinting at a cool down in demand amid rising fears.
Now, how significant is the rise in unemployment regarding housing stability?
Unemployment rates are predictive of housing demand. As it rises, caution sets in, impacting buyers' willingness to invest.
Fear seems to drive a lot of the market's reactions. Can you elaborate?
Absolutely. Fear often leads to rapid selling, reminiscent of 2008. When panic sets in, sellers may rush to unload properties, affecting prices.
Any predictions for the market in the upcoming months?
Expect increased fluctuations. Investors should tread carefully, balancing inventory levels against buyer sentiment and macroeconomic trends.
What about interest rates?
There's potential for rate adjustments in response to market conditions, unlocking new borrowing opportunities for savvy investors.
What's the final takeaway for our viewers today?
The housing market dynamics require vigilance and adaptability. Engaging with data while balancing emotional market responses is crucial for any real estate investor.
We want to hear your thoughts. What do you think the housing market will look like in a few months?
Drop your thoughts in the comments. It's a chance to get involved in the conversation about where our economic currents might lead.
Welcome to Ryan Scribner's YouTube channel. Today, get ready to master the art of index funds without breaking a sweat. What makes these funds the best choice for passive wealth building?
Index funds are the powerful tools for wealth building recommended by Titan investors like Warren Buffett. Stick around as we'll unravel the secrets behind this investment strategy.
So what's the gist of this masterpiece? What should viewers take away?
The core thesis is that index funds, especially S&P 500 funds, are recommended for their historical ability to outperform most actively managed funds, including hedge funds, ensuring a stress-free investment approach.
Let's dive into Buffett's infamous wager. What's the story here?
Buffett confidently bet $1 million that a simple S&P 500 index fund would outperform 5 hedge funds over 10 years, and it did, with a whopping 125% return.
Now, what exactly is an index fund?
They're designed to track a market index, pooling funds to invest across various assets, perfect for stress-free investing.
And what's the deal with ETFs?
Exchange-traded funds are the future, allowing investors to buy fractional shares for as low as $1.
What's the expected outcome if you invest long-term?
Historically, the S&P 500 returns about 10% annually, and reinvesting dividends can significantly accelerate that growth.
So, what does the future hold for passive investing?
We can expect a growing trend as more individuals turn to index funds and ETFs due to their simplicity and lower costs.
To wrap things up, what's the main takeaway for our audience?
Index funds offer an efficient, low-cost approach to build wealth over time. It's the smart choice for future investors looking to secure their financial future.
What are your thoughts on index funds? Will you be joining the Index Fund Investment Club?
Share your thoughts in the comments below. Your opinions could steer someone's investment journey.
Welcome back, everyone. Today, let's navigate the waters of refinancing your conventional home loan in 2024. Joining us again is the knowledgeable Jim Black. Jim, what insights do you have for homeowners looking to refinance?
Thank you. It's great to be here. We're diving into how homeowners with conventional loans can maximize their refinancing strategy.
So what's the core thesis of today's discussion regarding refinancing?
The key takeaway is that refinancing a conventional loan can potentially lower interest rates and overall payments, benefiting borrowers who assess their entire debt situation.
Let's break down some key points, starting with blended rates. What should trackers know?
Blended rates consider the entire debt profile. For instance, having a total outstanding debt of $750,000 with different rates results in an effective blended rate of 4.9%.
And how important is the break-even analysis in this process?
It's vital. Homeowners should analyze costs versus savings, ideally aiming for a break-even point of around 18 to 24 months or less to make refinancing worthwhile.
What about considering personal circumstances?
Absolutely. Life changes can affect the decision to refinance. If planning to move soon, refinancing may not make sense.
What's the process like for conventional loans?
The process is streamlined with a focus on keeping costs low. We aim to cover appraisal costs where possible to ease financial stress for borrowers.
How does empowering borrowers impact their choices?
Offering multiple financing options empowers clients to choose what's best for their situation, leading to more informed financial decisions. Education is key.
What predictions can we draw from Jim's insights?
Looking ahead, falling interest rates could encourage more homeowners to refinance, particularly beneficial for those currently burdened with high debt and expensive loans.
Any predictions for the mortgage industry overall?
Definitely. As more homeowners become educated about refinancing, we may see increased demand for these services. Trends suggest a significant shift in consumer behavior in the coming year.
What's the final takeaway for viewers regarding refinancing?
Strategically, refinancing can provide much-needed financial relief, but it's essential to assess personal goals and the broader debt landscape before deciding.
And how crucial are life changes in this scenario?
Life changes play a significant role in refinancing decisions. always evaluate your future plans before moving forward.
We'd love to hear your thoughts on refinancing. Are you considering it? What questions do you have?
Drop your comments below. Engaging with your questions helps keep the conversation alive.
Welcome back to Real Estate Mindset. Today we're diving into a shocking warning issued by Subway regarding the state of our economy.
That's right. Subway is calling for an emergency meeting with its franchisees across 19,000 locations due to tough economic conditions. Let's break down what's brewing.
So what's the core message we're getting here?
The focal point is that Subway's actions highlight severe issues facing consumers, with significant impacts on retail and fast food chains.
Let's unpack these key points. What are the consumer trends looking like?
Many consumers are struggling financially, with over 50% living paycheck to paycheck, which is seriously impacting spending habits.
And what about the price wars among fast food chains?
Absolutely. McDonald's kicked off the trend with $5 meals, and now competitors are scrambling to keep up as the pressure mounts.
The retail apocalypse sounds ominous. How severe is it?
It's dire. Many retailers are shuttering outlets, expecting up to 3,200 closures, while California alone is facing the closure of 4,000 restaurants.
What's on the horizon for retail?
Expect increased vacancies and more store closures as the economic conditions worsen. This will likely continue well into 2024.
Any predictions about potential strikes?
Yes, a strike by port workers could severely disrupt supply chains, resulting in higher prices passed directly to consumers.
To wrap it up, what are the big observations here?
The overall takeaway is alarming. The state of the economy is deteriorating, affecting everyday consumers and retailers. Viewers, what do you think? Share your thoughts below.
How will consumers respond to these challenges?
That's a key question. Will we see a changing of habits, or will it be more of the same? Comment your thoughts.
Welcome to Real Estate Mindset, where today we dive right into the housing market plunge that's making headlines.
Absolutely. The market's been turbulent, and with the latest report signaling a significant downturn, we have much to unpack today.
Let's discuss the fundamental message of this video. What's the core thesis?
The main focus here is the alarming drop in nationwide median sales prices, indicating a strong likelihood of a Federal Reserve rate cut in September.
What's the scoop on the market collapse?
Right. 3 of America's top investment banks are struggling, leading to heightened governmental oversight and intervention.
How is the housing market divided?
Great question. We're seeing a clear bifurcation. States like Texas and Florida are booming with active listings, while New York and New Jersey are much slower.
And what about interest rates?
Mortgage rates are currently sitting around 6%, and the market is buzzing with expectations of rate cuts this September.
Tell us more about the market indicators.
Absolutely. The median sales prices have seen a nearly $6,000 drop. Coupled with increased days on the market, it paints a troubling picture.
What are the predictions made in the video?
Well, many analysts believe the Federal Reserve might implement emergency rate cuts before September, provided the trend continues.
Any long-term predictions?
Yes, experts suggest we could see major interventions in the housing market around 2025 to prevent further deteriorations.
To wrap up, what are the key takeaways?
The housing market is in a delicate state. Observers are eager to see if the Fed will step in to stabilize this shaky foundation.
And for our viewers, what should they do next?
It's essential to stay informed. Consider signing up for real estate updates and let us know your thoughts on this housing storm below.
Today's discussions painted a vivid picture of the housing market's precarious state as we approach 2024.
Experts like Jim Black pointed out the importance of building strong foundational habits alongside economic realities.
Conclusions about forced sellers and inventory signals are stark and should not be taken lightly. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, thanks for watching Financial Insights in Minutes for August 17th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.